My name is Seewing Yee, and my special guest once again is Mr. Richard Advani, who is a top-notch real estate investment loan agent who does loans for investors in all 50 states. Richard Advani, thank you so much for your time. We are going to discuss. Let's go over what's going on with the real estate investment world. Right now, we're talking September 2023, how time flies. So Richard Advani is an investment loan agent who helped many investors to get financing for many years across most of the country. So without further ado, let me give you a quick recap of what's going on in today's mortgage rate. Today's mortgage rate based on primary home buyers conforming loan 30-year fixed rate mortgage today, September the 11th, according to Mortgage News Daily. The people with good credit are paying potentially 7.21% financing. So pretty high, historical high in the past 20 years. And here are the investment loan program that Richard Advani have with his loan company, Guarantee Rate Mortgage. As you can see, the various lending guidelines, Richard, that you put out every single week. And 30-year for investment homes, that is, rental properties, 30% down, you pay a certain amount of points at rates of mid sixes to low sevens. If you put 25% down payment, if you pay a certain amount of points, as you can see here, the rates are the high sixes and to the low sevens. And if you were to put 20% down on the rental property, the rates are in the mid to high, in the middle 7% range. And if you do a 2 to 4 unit, duplex, triplex, or fourplex, using Fannie Mae lending guideline, conforming loans, investment property, 25% down payment, almost 7% rate. If you pay 3.3 points to buy down the rate, and if you put a little bit less, you pay 7.25. And then finally, non-conventional loans, DSCR, couldn't even show that. It's 25% down payment. Whatever, I couldn't show the rate is like the mid sevens. And then now before I ask you for your thoughts. Now, of course, the other option is certain builders in the country, they are offering investor loan with a 64.99%. Builders will pay most of the points, and they're paying 5 points for you as an investor, so he can knock down the point to 4.99%. Like I said, in certain areas of the country, which is amazing buyer incentive, which we will probably never see again for a long, long while to come for real estate investors, so you can achieve better cash flow. But these are for pro forma. I'm not going to go over the pro forma, but some of these new construction investment homes available for investors, 25% down payment at various market. I'm not going to go over specific market. This is not the purpose of this presentation, but suffice to say, you will find this type of investment homes with this buy down rates 4.99% with the cash flow, as you can see, based on the purchase price, what have you. This is a single family home in the south and southeast, and then this is a duplex for this price, again, around 4.99 to 5.2%, give or take, based on the credit history. And look at the numbers, cash flow down here, as you can see, very good cash flow, relatively speaking. And finally, these are the brand new fourplex at $799, again, around 4.99%, give or take, and cash flow at 25% down payment in excess of $1,000 monthly net cash flow per property. So these are the options people have. So with that in mind, Richard, so you put yourself in your shoe. You are a real estate loan agent. You are guiding a particular buyer, investors. So giving the loan program you have available and the points to pay down, and certain markets have a builder incentive, certain markets the builder have no incentive. If an investor buy resale home, then there are very rare any incentive, and investors have to deal with those high investment rates. Should an investor do nothing right now, stay on the sideline, wait until things get better, or should they still use some of the loan program that you are promoting in with your lenders giving the high mortgage rate and points buy down that the investor have to pay down. And the question is, can you get enough cash flow? Where are you going to buy? In what part of the country you can achieve cash flow based on this higher mortgage rates? And then, of course, if investors are lucky enough to find a builder that are offering this amazing 4.99%, should you jump on it? If you qualify, whatever. So go ahead and share with me what your real life experience has been in the past few months with respect to all these options available to investors out there in different parts of the country. Go ahead, Richard.
Absolutely, yes. That example that you used showing the cash flow of that duplex really, I think, portrays a story that the rent to purchase price ratio is the highest that we've ever seen it, right? Even better than 8, 9, 10 years ago. The difference, so that's eating up cash flows, we're all aware, is of course the mortgage rates. But if you're looking at that example, I don't remember what the purchase price was on it, but if you look at the amount of rent once again coming in, it's extremely high. And so that leaves us at a position of course, what to do in this high rate scenario market. So firstly, if you do have the opportunity to get a lower rate with one of these builders that are incentivizing them, as you saw from that example, there's no reason to wait, right? There's tons of cash flow. The only reason why anyone's on the sidelines these days is interest rates. And that kind of takes that out of the equation, right? If you can get a 4.99 or low 5%, 30-year fixed on a rental property, 2+% lower than market, that puts you in a good position cash flow wise, but also keep in mind the lowest that rates are projected to go in the short term, which we'll all take this low point, right? Rates are ridiculous right now. The lowest they're projected to go in the next 6 months to year and a half, 2 years is maybe low 5s for primary home, which means mid to high 5s for an investment property, which is great, right? 2% lower than today. However, with these builders providing these incentives, you can actually get access to those rates today, right? The only difference is you don't have a herd of other people trying to come and buy the same property because market rates have now dropped and everything's more attractive. Definitely give Seewing a call on with these builders that are offering these rates. There's no strings attached. There's nothing weird going on. It is a conventional 30-year fixed loan. Bottom line, the builders are just paying 5, 6, 7 points on these deals to bring the rate down, to make the cash flow attractive for us as investors. And is Seewing rightly said, it's probably a once in a lifetime deal, right? I've never seen builders come out of pocket so much to buy down rates. And once the rate market changes around, they don't have to do that anymore. They're not going to do it, right? So take advantage of those properties now. If there's even some left, they're moving so quickly, as you can imagine. But what Seewing and I are trying to do is at least bring awareness to people that, hey, these types of programs exist, and the numbers make sense, and they're in strategic markets and they're new construction. So there's really no reason to wait for the rate market to change from where they are today.
Richard, I agree. However, what about investors out there that does not have the down payment or available to buy these higher price points in areas that we just talked about, Florida, Texas, and Indianapolis, wherever, with this 4.99% low programs available, because these prices are single family home in Florida are just shown is like $264,000 with 25% down payment. We're talking $70,000 down payment, and duplex in Florida also got $379K, 25% down payment. We're talking excess of $100,000 down payment, and a fourplex at $800K in Florida with the 4.99% program. We're talking like a down payment of almost $200,000. And not every investor, even from California, they have that much money. They qualify. Even if they do, they may not want to buy because they're in their mind is too much money out of pocket, too high risk, whatever. But what about the other areas of the country where there are no builder incentive, there are no 4.99% program, and giving the loan rates that on your chart that are available? So should investors still pull the trigger if they find a market like in Alabama, in a market that we have, cheaper, or even the Midwest? Although my company only promote so-called Midwest in Buffalo, Niagara Falls, because I feel comfortable with that market. But there are other areas in the Midwest you can buy property for $75,000 for a single-family home, $100,000 for a duplex, $220,000 triplex, and a fourplex you can buy $250,000. So what's wrong with using this temporary higher rate?
There's nothing. And people also look, then you stop looking at real estate so singularly in terms of the returns. And what I mean by that is, look, don't just, obviously it's going to make it hard to make your investment target goal. Not all of us want, right? Whether it's 5% or 7% or whatever it is, right? It's going to be very hard to make in this market. However, what do those numbers look like at a lower rate, right? At say 5.5%, even if you're going to take a 7+% rate today, when rates drop, whether it's 6 months or a year and a half, what are the numbers going to look like at 5.5, right? And is the property comfortable for you today, right? Can you make the acquisition? Is it going to be at least break even or close to it, right? So we're not saying go make an investment decision that doesn't make sense, but I think it's pretty general consensus, and everyone do your own research, educate yourselves, but that rates are going to come down at some point, right? Now, the question is at this point, whether it's going to be in the next 3 months or whether it's going to be in the first quarter of next year, but they are going to come down, right? So this is a 30-year investment plus for most of us, right? Or even a 10-year investment or a 12-year investment. So it's very easy to get caught up on the numbers that what they look like today, right? They're not reaching that 5-6% return that you have targeted. Run the numbers at say 5.5 or 5.75, right? Where rates are going to be within the next year, and see what the returns are then. And if those meet your investment goals, then once again, if you're at a 10, 15, or like me, a 30-year plus plan on these new construction properties, then I'm not so as concerned with what the next 1 year is going to look like, right? If I know rates are going to drop, and I'm not going crazy saying 4.5 and modeling it off of that, but even if I model it off of 5.75, right? What does that do to the cash flow? What does that do to my returns? And are those the desired returns that I want, right? And people don't look at real estate like stocks, right? Some years your stocks are going to be higher, some are going to be lower, some you're going to get dividends, some years you're not going to get dividends. And it's the same thing with this, right? This year, your first year, it's probably going to be a break-even investment. You're not going to get any dividends from this asset purchase, right? But once you refinance, as rates go down, then you're going to generate more cash flow and you are going to get dividends. And to give you an example, on a $220,000 loan on a 30-year fixed at 7.5%, the payment's $1,538 principal and interest, right? At 5.75, that payment, wow, is that even right? It's a crazy difference. Hold on here. I almost mistyped it. So at 7.5%, $200,000 loan, I'm running 200,000 you're at 1398. At 5.75, it's at 1167, right? So that additional almost $200 a month in cash flow on an investment, right? That's $2,400 a year on your down payment on this property is going to be about $70,000, right? You're increasing cash flow, you're increasing ROI with this additional cash flow that you're going to get adds up. It's probably going to double your cash flow, right? Most of these properties you're buying right now are only going to have $150 to $175 to $200 a month in cash flow, and maybe it's making you 3%. When rates drop, as we just saw, that cash flow is going to double, right? Your 3% is going to go to 6%, and it's going to be more in line, obviously, with what our real estate investment objectives and goals are. The thing it's going to save you from is crazy higher prices, 50 people trying to buy the same property when rates drop, right? So you're getting ahead of that curve, knowing that, hey, when rates drop and everyone else is running to buy all these properties, all I'm going to have to do is refinance because I already have the property. So that added value of lower rates, which is going to push all these people to buy, you're still going to be able to take advantage of that. The only difference is you own the home. The only risk to you is, what if between now and 8 months from now, when rates drop, house prices are going down, right? Maybe I should wait till that's not going to happen. Now the media agrees. It's all over the news. House prices are not going down. They haven't gone down. They're projected to go up slightly, but they're projected to go up through next year. So why wait, right? That's the biggest question. Why are you waiting if we know that you can refinance in the very near future and avoid being a retail home buyer, right? And want to be greedy when other people are fearful and be fearful when they're greedy. Most people are fearful right now, and they've been fearful the last couple of years and lost out on tons of riches. But yeah, that's my take.
Yep. So my quick takeaway from what you said, Richard, is that it's never wrong time to buy, but as long as you buy in a good market, surround yourself with a good team, you date the interest rate, but you marry your investment properly. And so it's all about buy real estate and wait instead of wait to buy real estate. So that's my takeaway. Very great recap, Richard Advani. Thank you so much. That's all we have to say on this particular module. Thank you so much.